Wake up. Michael, wake up.
What? It feels like I just fell asleep.
You did. 2 hours ago. Wake up.
Are you crazy?
Michael, today's a very big day. Something very big is going to happen.
Something big? What?
I can't say.
Give me a hint.
I can't say.
Who are you again?
Michael, we need to talk about money before morning.
Money?
Have you ever thought about what money is? Money doesn't have to be coins or bills. Money is anything people accept as money. Money can be seashells or electronic wire transfers.
Talk slowly.
Money has existed for over 3,000 years. It was invented to replace barter and make trade easier. You don't have to give a goat now in exchange for a chicken. You can give a bill, and the farmer can use it later to buy whatever he wants.
So you can use money to buy things.
Actually, money plays 3 roles. First, money is a means of exchange. You exchange a good or service for cash. Second, it's a store of value. It keeps its value over time, so you can use it to buy ice cream today or next week. Third, money is a unit of account. You know how much something is worth when compared with other things. For example, this stick may be worth $50, while something else is worth $5. For a long time, people used gold or copper coins. Even in the 20th century, paper money could be converted into gold.
I can exchange my money for gold?
Yes, once you could. And you could still buy gold with your money, like you'd buy any other good. But today money has value because the government says so, and everybody else believes it.
And if people stop believing?
Then the economy collapses, and your savings are gone.
Ouch. Say, what about bitcoins?
They're a kind of money, since some people accept them as payment. But it's highly speculative, so it's not reliable yet. To make sure money keeps its value, government manages a country's money supply.
Money supply?
Money supply is the total amount of money that exists in a country. There are 3 main measures of it. The first is called M1. It's cash, the sum of all coins, banknotes, and checking account balances that people can access and use anytime. The second is called M2. It includes M1 plus all the savings accounts, money market accounts, and other investments that can be turned into cash very quickly and easily. The third one is called, you never guess it, it's called M3. M3 is M2 plus investments that are slightly less liquid but can be converted into cash with some time lag or cost. Many bank certificates of deposits are included here. They are time deposits in banks, which can be withdrawn before maturity but against a small fee.
I see.
Do you? Let's test it. Which of the following instruments are part of M3, but not M2? Money market funds, CDs, stock mutual funds.
CDs? As they can be converted into cash but at some cost. So that's M3, not M2.
Right.
Money market funds are in both M2 and M3, and stock funds are in neither?
Absolutely right. Money market funds invest in safe, short-term debt instruments, so they have a stable value and are liquid. That's M2. Stock funds invest in various stocks. They are also liquid, but their value keeps changing as the value of the stocks they own fluctuates, so you can't really count them as money. Which of the following instruments falls into M1 as well as M2? Checking accounts, savings accounts, time deposits.
Checking accounts, I guess, because they're basically just like cash. Unless they're empty, like mine.
Excellent job! Now, let's take a closer look at banks. Money and banking are related and super important. For example, what exactly is a bank, and what does it do? Banks are institutions that collect money from large numbers of depositors and lend it to different borrowers for various purposes. Some banks also engage in other activities. The main types of banks are commercial banks, investment banks, credit unions, and savings and loans. You can learn the differences between them later.
But why do we actually need banks?
Banks play three essential roles in an economy. They provide savers with a safe place to store their wealth. They facilitate trade by providing a convenient payment system. And they connect savers with borrowers. This is all critical for economic growth. Savers can save safely. The Federal Deposit Insurance Corporation guarantees all bank deposits up to $250,000. Businesses and households can borrow for investments. Banks can lend them money for long periods of time, which is what many investors need, while offering depositors liquidity of their savings, meaning they can withdraw them anytime they want. Banks have access to Fed support in case they need help with this.
Wait, Fed support?
Yes, if banks are short of cash, they can borrow money from the Federal Reserve, or Fed. In fact, the government uses the Fed to influence economic growth and inflation.
That's reassuring, but what went wrong in the 2008 financial crisis?
The main problem was in the housing market. Before the crisis, many homeowners had bought homes they couldn't afford, with mortgages that were too easy to come by. When the housing market turned sour, these homeowners were unable to repay their mortgages. Debt securities based on those mortgages defaulted. Many investors lost their shirts, and major banks went bust or had to be bailed out by the government.
Got it.
Did you? Let's see. Which of the following was a major factor in the 2008 financial crisis? Foreign currency speculation?
No?
Right. What about emerging markets?
No.
Right. What about low-income housing?
Yes.
Well, you've learned what you needed to know for today.
Okay, so I learned something, but what about the rest of us? Were any changes made following the crisis?
Yes. New regulations were issued. For example, stricter guidelines for capital adequacy and liquidity of banks, and better oversight of the financial system. So things are better now, though they're still not perfect. Now you can go to sleep. Good night.
Wait, you got me up for this? What was so urgent about it?
You'll find out later today.
What does that mean?
My lips are sealed. Till next time.